Okay, looks like we're live. Good morning, everybody. Welcome to Live Valuation. I'm Midas. Today we're going to be looking at ticker COLL, Collegium Pharmaceuticals. Just give me a moment to make sure everything is up and running in appropriate location. Okay, so Collegium Pharmaceuticals, they're a pretty interesting company. We'll have to see kind of value we can find for them. They're the primary producer of two major products, both of which are kind of in the same space, which is alternative opioid medication. Um, their primary medication, Tamza, I'm not really sure how to pronounce it, but something like that, is the one that they themselves have developed and have gotten approved through the FDA. I'm pretty sure they got approved in 2016, if I remember correctly. They IPO'd in late 2014, late 2015, late 2015. And when they IPO'd, according to their S1, they kind of had a approximate TAM of around 11 million patients, which is for essentially the uh, acute acute extended release opioid alternative patients, with specifically people who have difficulty with swallowing, because that's part of the alternative medication availability for them, is the ability to have a chewable product. Because the problem with other opioid medications, such as like OxyContin, is that when you break the medication up, you can mix it with other products and make it into a much more faster hitting or more powerful medication, which is used for recreational and abusive usages. So that's part of the problem with it, and one of the reasons that the abuse has gotten so widespread, much mixed with a lot of the problems in the prescription system itself. But because of the ability to abuse the product, so there's been a lot of work to try to create opioid medications that can't have the same level of manipulation on a recreational level. So what Tampa specifically does is be able to be mixed into, is to be able to be broken down into a powder, even be mixed with food and other such things, or just be chewed and crushed with one's teeth, without actually increasing the speed at which it absorbs the medication, which is one of the key factors that creates the ability to manipulate its chemical structure with other household chemicals or things like that. So they got that one approved, like I said, in 2016, and it's been slowly rising on the market, while for OxyContin has been dropping on the market. While the entire market itself has also been dropping over the last few years. As I said, they had an approximate TAM of 11 million patients in 2015 when they IPO'd. However, in their most recent 10K, they had adjusted that TAM to approximately 40 million. However, that has to be taken into account that also includes a decent amount of more chronic pain patients, because of the acquisition they made last year of their second product, which is a major product, which is Nukinta, which, again, as I just said, is more of a chronic pain management tool than an acute extended release pain management tool. So between that, they have a self-proclaimed TAM essentially of approximately 40 million patients, which is little more than 10% of the United States. And this is basically their U.S. TAM as well, for the record. They don't speak about the numbers outside the U.S. They have applied for patents, and even have a couple of them for Tampa in a couple other countries, and then, like I said, they're applying to a few others. No, I didn't see any word on that as far as Nukinta goes. But either way, so the 40 million total patients, according to market research that they state in that same 10K, comes down to approximate market size of $1.4 billion in the most recent year. So if I do a little bit of math compared to the amount of scripts that they have for their medications, that gives them to an approximate market share of 9%. Just to give sense of scale, I think OxyContin was like 70 something percent. So there's a lot of room to move. And OxyContin's share of the market has been dropping year over year for the last several years. While, like I said, the total market size has also been dropping actually since it peaked a few years back. So it did rise, like I said, pretty significantly since their IPO, but it also has dropped in the most recent few years, partially because of the growing awareness of the opioid abuse problem. So that's good, I suppose. As I implied, a huge part of the actual opioid abuse problem has to do with the prescription system, in my opinion, more than the actual medications. So that is pretty good. I think that's a part of the issue. Is awareness will help solve that problem. But changing the medications to make it less easy to abuse without having majorly negative side effects as well would be great as well. Part of the reason we're looking at this company. So either way, we're using, like I said, this 1.4 billion TAM with 9% market share as sort of our base, and then we're going to work with I worked with a bunch of assumptions to come up with some revenue numbers, looking at, for example, the rate of decline for OxyContin has been pretty significant. In the most recent year it was like 20%, but over the last several years it's been closer to like a 10% decline CAGR. So we're going to assume that perhaps they even on a certain base level, maybe even they have 5% decline as a worst case scenario in their own revenues, even though their own revenues have been growing significantly during this time frame, even while the TAM drops. But let's assume that even worst case scenario, maybe theirs drops as well. Maybe not as fast as OxyContin, maybe only half as fast. But that would still be them not being able to pick up market share enough to actually make the revenues grow as a worst case scenario. So I'm going to use sort of like a negative 5% as like a revenue base, or actually I think that's, never mind. Actually, last night I went from negative 5%. I decided to actually go all the way to negative 10% as a base. I kind of forgot. I changed my mind on that one. I decided to just put it in line with OxyContin rather than assume they made work. Forgot about that for a moment. I had it written here on this notepad 5%, so that's why I said that. But either way, on the upside of things, we assume that a different set of assumptions for the top side of revenue, which is to say that we assume that there's going to still be a 5% decline in the overall market of the TAM no matter what, but that they actually make significant share gains as a result of that, and that we actually assume that about half of all of the loss from OxyContin goes to Collegium specifically. And then with this assumption, we also assume that because of this, they can do a price increase for about 5% per year or so, which is, I think, pretty conservative. It's possible they could be pretty significantly higher than that. And I did work with their sales numbers to work back to figure out what the price was last year to use that as a base, which I came up with about $230 per script. That doesn't specify what the form of the script is at all. They just gave me script numbers, and they gave me the numbers for the medication, so that's probably an adjusted for a bunch of rebates and other things, so it's probably more like an effective script price than like a price that's listed or something. But either way, that's sort of the math I did, and either way, like I said, I used the 5% sales price growth to come up with an eventual future price in 5-year forward period, applied the half of the share loss from OxyContin to Collegium, gave them that share price, and they gave me to a top line revenue of possibly $920 million in revenue. And that's only Tampa. That actually doesn't take into account their acquisition of New Quinta. And I'm basically going to just assume that it's all in there together and consider that one mixed number, on the basis that when I use these model distribution chunks, they're only usually in 5%. So the top 5% of, even if I'm going to put it at about 946, which is still a little bit higher than 920, but again, we're kind of ignoring New Quinta, so I was fine with that, just to give it around 25. But we're just going to allow that to be the top line because of the fact that it's a total 5%. Because if I was really to assume that best case scenario to happen, I don't really even think 5% is a fair percentage. Honestly, maybe more like 2 or 3%. So the extra couple percentage points, I'm basically just gonna cherishably say that's New Quinta's contribution to the value. And either way, so that's how I'm getting to this revenue expectations of -10% to 25%. And as far as the analysts, I haven't really looked at that yet. So we'll look at that later on. We'll take a look at what they're saying. It might be like 5 to 10% or something for them. But I just wanted to explain this part first: the business, their drug, and my revenue expectations. Even though I haven't done the other stuff, normally I would do financial statements first before I get into a long explanation of my revenue expectations. It's worth noting, like I said, I'm willing to give them the cherishability of the 5% on the top end here, but I'm not going to be giving them like a large run up to it. It's probably going to be a very tail-ended type of a scenario. Just so we're clear, that's probably more likely the scenario is something like this, maybe 30. I don't know. We'll come up with it more specifically after the fact, but it's probably gonna be this tail-ended thing where these high-end probabilities have a really low percentage relative to the kind of middle range potentialities. So that's basically what we're looking at. It's like, yes, this is a pretty wide range of revenues, but you'll see that it's actually going to be very much centered kind of around here with just some tail-end probabilities of negative and positive outcomes. So but that's what we were doing, is we were sort of just trying to come up with our revenue range and think about it probabilistically, what kind of scenario we're probably dealing with based off of the drug they're doing and the type of research they're doing and what they're trying to achieve and what we personally think about that market. So we do need to do the financial statements, and there's actually still some other stuff to do on that front too. I normally would have all of my prep work done for streaming, which means doing all the segmentation, which is easy for them since they're just in one business and it's just in the US. So actually that stuff's all done and the debt's done already. However, I haven't copied all of their financial data from the Excel tables into it and then lined it up smoothly. So I do have to do that a little bit, which is going to take a little bit of extra time. However, they also only had 6 years for me to put in. So normally we would have 10. So I think that sort of makes up for the fact that there'll be a little bit less time. But I do need to do this. But while I do that, we will listen to their quarterly earnings call from Q2 on August 5th. And if there's time after that, which probably there will be because it seems like it's a pretty short one, then we will also listen to this conference they did recently at September 28th, Counter Global Healthcare Conference. Which I've already listened to both, but it'll be good background noise while I'm working, and I might make a couple comments on some of the things they're doing while I'm doing it.
Greetings, and welcome to the Collegium Pharmaceuticals second quarter 2021 earnings conference call. At this time, all participants are in a listen-only mode. A brief question and answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press *0 on your telephone keypad. As a reminder, this conference is being recorded. It is now my pleasure to introduce your host, Alex DeSala, Head of Investor Relations and Corporate Communications.
Welcome to Collegium Pharmaceuticals second quarter 2021 earnings conference call. This is Alex DeSala, Head of Investor Relations for Collegium. I'm joined today by Joe Schiavone, our Chief Executive Officer, Colleen Tupper, our Chief Financial Officer, and Scott Dreyer, our Chief Commercial Officer. Before we begin today's call, we want to remind participants that none of the information presented today is intended to be promotional, and that any forward-looking statements made today are made pursuant to the Safe Harbor provision of the Private Securities Litigation Reform Act of 1995. You are cautioned that such forward-looking statements involve risks and uncertainties, including and without limitation, the risks that we may not be able to successfully commercialize Xtampza ER and the Nucynta franchise, and that we may incur significant expense and may not prevail in current or future opioid industry litigation and investigations, patent infringement litigation, or other litigation pertaining to our products. These risks and other risks of the company are detailed in the company's periodic reports filed with the Securities and Exchange Commission. Our future results may differ materially from our current expectations discussed today. Our earnings press release and this call will include discussion of certain non-GAAP information. You can find our earnings press release, including relevant non-GAAP reconciliations, on our corporate website at collegiumpharma.com. I will now turn the call over to Collegium CEO, Joe Ciaffoni.
Thank you, Alex. Good afternoon, and thank you everyone for joining the call. Today we will discuss our performance during both Q2 and the first half of the year, in addition to our outlook for the remainder of 2021. At Collegium, we remain focused on our mission of being the leader in responsible pain management. I want to take a moment to recognize my colleagues for their hard work and thank them for their commitment to people living with pain and the communities we serve. During the second quarter, we expanded our partnerships in support of life sciences and education in disadvantaged communities with a donation to Science from Scientists, a nonprofit whose mission is to improve STEM literacy. Our contributions will fund multiple STEM programs for the upcoming school year. We are dedicated to delivering on our mission, driving growth in our business, and creating value for shareholders. We will do this by maximizing the potential of our differentiated portfolio of pain products, achieving our near-term operational and financial goals, and strategically investing in our long-term growth. I am pleased to report that in the first half of 2021, we made meaningful progress against the priorities that we outlined for you at the start of the year. Our business is strong and our people are healthy. We are in a phase of growth and value creation, and we are on track to achieve our objectives for 2021. Notable accomplishments in the first half of 2021 include: we posted record revenue, net income, and adjusted EBITDA. We expanded our market position with Xtampza ER, delivering all-time highs in market share and total prescriptions. We grew Nucynta franchise net revenue to over $100 million, a level not seen since 2018.
Xtampza. I don't know why I can't remember that, but Xtampza.
And we grew cash on hand to over $200 million. Xtampza ER prescription growth and market share gains were strong in the first half of 2021, driven primarily by new Medicare Part D formulary positions that took effect on January 1st. COVID-19 dynamics adversely impacted the market, in-person patient visits, and our field force's ability to make in-person office visits. The combination of these factors resulted in Xtampza ER prescriptions skewing to exclusive plans, which pressured gross to net relative to our expectations. Although we are seeing signs of progress, we anticipate that COVID-19 dynamics will persist in the near term, and as a result, we are adjusting our full-year guidance for Xtampza ER and the Nucynta franchise. For the remainder of 2021, we are focused on growing market share with Xtampza ER and improving the mix of business. Over time, we are committed to managing Xtampza ER gross to net to less than 65% by improving mix of business and optimizing payer contracts. The Nucynta franchise grew revenue in the first half of 2021, driven by favorable gross to net dynamics, offsetting pressure on prescriptions. For the remainder of 2021, we expect Nucynta franchise prescriptions to stabilize and favorable gross to net dynamics to continue. Operationally, we achieved our key objectives of leveraging our cost structure, specifically our operating expenses, excluding stock-based compensation, and generating strong cash flows. For the remainder of 2021, we continue to be focused on executing on our growth plan and creating value for our shareholders by deploying our strong balance sheet in a disciplined manner. Our business development strategy is focused on diversification. Specifically, we are seeking to diversify the company in one of three ways. First, financial diversification, like the Nucynta acquisition, where we are focused on commercial stage, high synergy opportunities that would directly leverage our cost structure. Second, diversification through the acquisition of later stage development defined as phase 2 ready or later non-opioid pain assets. Here we are pursuing programs that have the potential to generate revenue in the 2025 to 2027 timeframe and that have peak sales potential of at least $150 million. And third, we are pursuing commercial stage, lower synergy acquisitions that would establish a strategic beachhead into adjacent therapeutic areas. Business development remains a top priority for the organization, and we look forward to updating you on our progress. We are encouraged by our revenue performance in the first half of the year and by the underlying trends in our differentiated pain portfolio. We are on track to achieve our objectives, but recognize we have a lot of work to do. I will now hand the call over to Colleen for a discussion of the financials.
Thanks, Joe. Good afternoon, everyone. Before I start, I want to extend my thanks to my new colleagues at Collegium and recognize their contributions and many talents which have helped me greatly as I transition to the role of CFO. I am truly excited to be at Collegium, and I'm looking forward to the journey ahead. With that, let me jump into the quarter. In the face of COVID-19, Q2 was another strong quarter for Collegium, as we leveraged our operating cost structure and generated meaningful cash flows from operations. Total product revenue was $82.9 million for the second quarter, an increase of 6% from the second quarter of 2020. Xtampza ER net revenue was $33 million, a decrease of 2% from the same quarter last year and a decrease of 7% from the first quarter of 2021. In the second quarter, we saw underlying volume growth across all books of business, but COVID-19 remained a challenging dynamic, particularly in the non-contracted and non-exclusive books of business. Because of this dynamic, mix of business skewed to exclusive accounts, in particular Medicare Part D, resulting in a gross to net discount of 69.5%. Looking to the second half of 2021, we expect Xtampza ER to continue to grow at a moderated pace and consistent with what we have seen in prior years. Moving to Nucynta, in Q2, gross to net discount was again better than our expectations, and we expect the franchise to continue to benefit from favorable gross to net dynamics for the remainder of the year. Nucynta franchise net revenue was $49.9 million in the second quarter, an increase of 12% from the second quarter of 2020 and a decrease of 5% from the first quarter of this year. Operating expenses, excluding stock-based compensation, were $27.3 million in the second quarter, compared to $26.2 million in the same quarter last year and $27.5 million in the first quarter of this year. The decrease in Q2 operating expenses, excluding stock-based compensation, compared to Q1, reflects our continued commitment to leveraging our cost structure. Our non-GAAP adjusted EBITDA was $40.1 million for the second quarter versus $39.1 million in the...
All right, so now we've copied all the financial statements in the raw data. Now we can put it together into the format that we like to read it through.
Tax valuation allowance on the majority of net operating losses and other deferred tax assets. Please see our press release issued earlier today for a reconciliation of GAAP to non-GAAP results. As of June 30th, our cash balance was $202.8 million, which is a $20 million increase from March 31st. This is the fifth consecutive quarter we have increased cash on hand. Now, on to 2021 financial guidance. Due to the ongoing impacts of COVID-19 on our business and gross to net dynamics across the portfolio, we are updating our previous product guidance communicated on May 6th. For 2021, we now expect Xtampza ER revenues in the range of $140 to $150 million, down from $155 to $165 million, and Nucynta franchise revenues in the range of $195 to $205 million, up from $185 to $195 million. We would note, although product mix assumptions have been adjusted, expectations for overall revenue remain consistent from the start of the year. As such, we continue to manage our P&L to the plans we laid out entering 2021. For the full year, we continue to expect total operating expenses, which includes stock-based compensation, in the range of $125 to $135 million, and adjusted EBITDA, which excludes stock-based compensation, in the range of $170 to $180 million. Let me finish with this summation and key points. COVID-19 continues to impact our business, particularly as it relates to gross-to-net dynamics across our product portfolio. But despite these dynamics, Q2 was a strong quarter for Collegium, and our overall revenue and cash generation performance was solid. For the remainder of the year, we are focused on continuing to execute commercially, leverage our cost structure, generate cash, and deploy our balance sheet in a disciplined manner. I will now turn it over to Scott.
Thanks, Colleen. I'm pleased to report that we continue to generate momentum for Xtampza ER and successfully manage the life cycle of the Nucynta franchise, which has resulted in a strong first half of 2021 and positions Collegium well for the remainder of the year. I'm encouraged that Xtampza ER was once again the fastest growing ER opioid and achieved all-time highs for total prescriptions, market share, and total prescribers in the second quarter. The actions we took in late 2020 enabled us to pull through our new exclusive ER oxycodone formulary positions and continue to grow share within our 2020 exclusive wins, building momentum and further advancing the market position of Xtampza ER. Xtampza ER total prescriptions grew to greater than 173,000, up 22% year over year and 7% sequentially. Xtampza ER exited Q2 with a 31.5% share of the ER oxycodone market, up 1% from Q1. There were approximately 19,000 prescribers of Xtampza ER, a 33% increase versus the second quarter of 2020, and a 5% increase versus the first quarter of 2021. Xtampza ER share performance within exclusive accounts was very strong in the second quarter. We continue to see market share and volume growth within all new exclusive formulary wins, as well as continued share growth within the exclusive formulary wins we had achieved in 2020. Similar to Q1, Xtampza ER growth skewed toward the exclusive accounts, and in particular Medicare Part D. While we did see growth in the non-exclusive and the non-contracted books of business, it was behind our expectations and continued to be impacted by the ongoing COVID dynamics. For the remainder of the year, we're focused on growing Xtampza ER market share within our non-exclusive books of business. Moving to the Nucynta franchise, Nucynta franchise total prescriptions and market share were stable in the second quarter. For the second quarter in a row, we saw strong results from the execution of our payer strategy, which is aimed at improving the profitability of the franchise. Through the continued execution of our payer strategy and overall commercial execution, we believe we can stabilize prescriptions for the remainder of the year. Looking to the second half of 2021, while we've seen some improvement in patient visits to the healthcare professionals and the ability of our reps to access physician offices, the COVID pandemic remains a persistent, challenging dynamic in the marketplace, and the Delta variant introduces uncertainty. As a result, we anticipate that Xtampza ER will grow in the second half of the year, albeit at a moderated rate versus the first half of the year, and we expect Nucynta prescriptions to be stable. We remain confident about the outlook and market position of our pain portfolio, and we're focused on finishing strong in 2021. I look forward to updating you again on our progress on future calls. With that, I'll turn it back to Joe.
Thanks, Scott, and I will now open the call up for questions.
Ladies and gentlemen, we will now have our question and answer session. If you would like to ask a question, please press star one on your telephone keypad. A confirmation tone will indicate that your line is in the question queue. You may also press star two if you would like to remove your question from the queue. One moment, please, while we now poll for questions. Our first question comes from David Amsellem with Piper Sandler. Please proceed with your question.
Hey, thanks. So just one on Xtampza and then one on the Nucynta franchise. So first on Xtampza, I guess given the situation with the gross to net, and given that you're gaining share in the ER oxycodone market, and given that patients tend to be sticky here, does it make sense to shift your focus to non-exclusive or parity positioning and try to rework some of these contracts? Is that a way to course correct if you think you need to course correct at all? So that's the Xtampza question. And then on Nucynta, you seem like you've had success with the strategy of ridding yourself of contracts with suboptimal economics. Is there any more work you can do there to further improve economics? In other words, are there other contracts that you're evaluating, and what could we potentially see there beyond 2021 for the franchise? Thanks.
Hey, David, this is Joe. Thanks for the question. I'll take the Xtampza question, and then Scott will take Nucynta. So look, when you look at Xtampza gross to net, let's take a step back, and I want to emphasize we believe the situation that we're seeing is driven primarily by COVID dynamics, and we expect it to be temporary and transient. As we said in our prepared remarks, the way that we're going to focus on addressing it is focusing in on improving the mix of business, in particular deriving more prescriptions from contracted non-exclusive and even plans in which we're non-contracted, and then over time optimizing contracts when we have the opportunity to do so. 2022, as an aside, is a year where many contracts will be up for renegotiation, and we'll have opportunity to optimize those contracts. So the final comment I would make on Xtampza is that we expect and we're committed to managing gross to net to less than 65%, and we expect to be under 65% no later than 2023. And I'll let Scott take the Nucynta question.
That's great. Thanks, David. Yeah, so when it comes to Nucynta, we're happy with the execution of the strategy and what it's resulted in. We really evaluate this on a contract-by-contract basis with the attitude that we always want to have the broadest access we can for our products, but it has to be at economics that work for us. And so going forward, absolutely, we'll be evaluating upcoming Nucynta contracts as they expire. If we have the ability to maintain access and improve economics, we will, and in some situations, we'll make the choice to walk from a contract. So there is opportunity going forward to continue to optimize for Nucynta.
Okay, thanks, guys.
Great. Thanks, David.
Thank you. Our next question comes from David Steinberg with Jefferies. Please proceed with your question.
Thanks, and good afternoon. I have a couple questions. I guess just drilling down on the impact of COVID on Xtampza and the resulting weaker gross to net. I was wondering if you could provide a little more clarity. So just so I understand it, obviously the salespeople can't make as many visits to the doctor's office, but could you just give us a little more information on how this works in terms of physical meetings between the doctor and the patient? And are you saying basically that unless there's an in-person meeting, a switch can't happen? And if that's the case, I mean, the pandemic could go on in various forms for years and years. Are there no workarounds if that's the case, so that there can be a switch without this in-person meeting between doctor and patient? And then just shifting to M&A. I know BD has been on the front burner for a long time with the company, and just curious, as you build up the cash, you have more opportunities as well as debt capacity. In terms of looking at the companies, is it just a question of valuations being too high, or that you just can't find anything that really fits what you want to do, or in fact, have you bid on some assets that you lost? And then related to that, Joe, would you consider branching into other areas besides pain, where you can leverage your sales force? Are there any areas, are there ancillary we can use the same sales force, or would you have to have a whole new sales force if you were to branch out into other areas besides pain? Thanks.
Yep, great, David. Thank you for the questions. I'll take both of those. And look, maybe what I'll do to the first question in terms of what we think the dynamic is with Xtampza, I'm going to step back and give a little perspective on what we think is happening in the market. So first off, we believe COVID is impacting, and I want to be specific on this, the dynamic portion of the market. And as you all know, 85% of the extended release market is driven by patients on an immediate release opioid transitioning to an extended release opioid. If you look at the overall market from a total prescription perspective this year, it's performing in line roughly to what it is we would have expected. It's the new to brand market, which is where that dynamic and the changing of products is where you see the pressure. And the end result of that is a higher level of a continuity of care than what it is we would have anticipated. Now, the primary driver that we believe is having impact is that in-person patient visits with physicians is off. Now, it's not that physicians are unable to switch a patient, but what we've learned over the past year and a half is all specialists in general, their switching is less productive if they're not seeing the patient in person. But pain specialists in particular are more reluctant to switch an otherwise stable chronic pain patient. And so that's dynamic is where we think we're seeing the pressure when we don't have the support or the payer driving ER to ER switching, where we're seeing the physician keep the patient on whatever therapy they're on if they're not seeing them in person. Secondarily, we also know that our field force's inability to make in-person office visits at the level they were able to pre-pandemic is also a factor. And then the final thing, just to complete that, I would say, is although we're seeing some signs of progress, it hasn't been steady. It starts and stops around the country, and with where we're at with the Delta variant, when we look to the remainder of this year, we do think COVID-19 dynamics will persist. Okay? Now, with regards to business development, on that front, I'm going to first off emphasize, as I always do, and I think it's important because it will really clarify what we're doing in our approach. Our core business is strong. We are in a growth phase. We're generating cash, and our assets are durable. So because of that, we are always going to be disciplined in our approach. Now, for the past year or so, we have been active, we have been focused, and we've been engaged. And so to your question specifically, David, where are we at? As it pertains to commercial stage high synergy and later stage development assets, we know what we like, and we also know what we believe makes sense from a value perspective. And the one thing that we won't do is we're not going to overpay for any opportunity. We don't feel that we have to do a deal, so we're looking to do a deal that really makes sense for the company and for our shareholders. And so because of where we're at in those two areas, we've expanded our focus to what we refer to as commercial stage lower synergy acquisitions, which would bring us into adjacent therapeutic areas. And the reason we call out lower synergy is in those scenarios, we wouldn't be leveraging our current field force, but we would be taking on or building a field force effort to support that asset. So we would realize some synergy, but not the way we would in other types of acquisitions. And I'm not going to get into, or I'm not inclined to get into the adjacent areas we would look at, but because I did reference it on our last call, I would say we do believe in like and think neurology makes sense for Collegium.
Okay, thanks, Joe.
You got it. Thank you.
Thank you. Our next question comes from Tim Lugo with William Blair. Please proceed with your question.
Hi, guys. This is John on for Tim. Thanks for taking our question. So I was just wondering if you could give any updates on how payer discussions are going ahead of the upcoming contract season, And as another one on Nucynta, do you feel that the franchise has reached a point of stability, or do you still see some variability in how we should think about the seasonality of the franchise moving forward? Thanks.
Yeah. So, John, I'll let Scott take the question on the payer discussions, and then I'll come back on Nucynta.
All right, thanks. Yeah, thanks, John. So, nothing new to report right now, but as we typically do, a lot of decisions are made in the second half of the year here, and we'll give you an update on the November call related to any wins that we have in place for next year. But I will reinforce strategically what we're trying to accomplish, right? We're still looking when it makes sense and being selective, but for new exclusive wins or for parity wins, and then sometimes parity as a run-into exclusive. And the only additional thing that Joe alluded to earlier is we're now at a point where we may have some opportunity to optimize contracts for Xtampza, more on the edges as we enter 2022, and then a greater opportunity as we enter 2023.
Yeah, and John, as it pertains to Nucynta, for the remainder of 2021, our expectation is that we'll see stable prescriptions for the remainder of the year. On a going forward basis, and it will be dependent upon what we do in the payer space for the remainder of this year, but candidly, I don't anticipate significant changes to the access position of Nucynta. Seasonally in the first quarter when deductibles reset, that's where you may expect to see some downward pressure on prescriptions, but we think it will be offset by our pricing and contracting strategy, which is why I would reinforce we expect to be able to deliver on a sequential relative basis, relatively stable revenue with the Nucynta franchise from now through loss of exclusivity.
Thanks so much.
You got it.
Thank you. Our next question comes from Rohit Basin with Needham & Company. Please proceed with your question.
Hi, this is Rohit on for Serge. Thanks for taking my question. Is the penetration of Xtampza in the most recent exclusive formularies on par with those for prior years? And given the challenges, does the strategy for the next set of formulary wins change?
Yeah, thanks, Rohit, for the question. So our performance in exclusives this year has been just as strong as it typically is. And as we alluded to, the overhang or the issue that we're up against is the performance in the non-exclusive books of business because of COVID. So exclusive performance is strong, both the new 2021 wins and continuation of the 2020 wins. And as a result of that, strategically, we're still focused on selectively winning new accounts.
And Rohit, the one thing I would emphasize, and I said this in my prepared remarks, the pressure on gross to net that we're seeing, we think one is a COVID dynamic. We think it's temporary and transient. And the most important thing when you think of Xtampza moving forward as we continue to expand our position in the market from a share perspective, which we expect to continue to do, we are confident through the optimization of contracts, and we are committed to managing the brand at a gross to net of less than 65% for the long term. So we're really encouraged and excited about the share and the market position of Xtampza.
Great, thank you.
You got it.
Thank you. Our next question comes from Greg Fraser with Truist Securities. Please proceed with your question.
Hey guys, thanks for taking the questions. On Xtampza, can you comment on how overall prescription share growth has trended relative to your expectations? It sounds like the mix of business is the primary driver for the guidance change, but I'm curious if recent share growth has kind of lagged what you were expecting.
Yeah, Greg, this is Joe. I would say that what we're seeing with Xtampza from a share perspective is in line to expectation. The challenge that we're experiencing is more mix and where it is that it's coming from.
Got it. Okay. Is it fair to say that the revised outlook does not assume a material pickup in volumes for the non-exclusive and non-contracted books of business in the second half?
Yeah, I would say, look, this year we've seen progression across all books of business. So we expect to see growth through the remainder of the year. But right now, look, sitting here today with the Delta variant, what's going on around the country, What we're calling out is I think it's reasonable as we look to the remainder of the year to say that we would expect COVID dynamics to persist. And our expectation when we started this year and even as recently as the last call that we would be returning to a new normal in the back half of 2021. And we don't necessarily think or aren't planning on that happening.
Understood. Okay. And then on expenses, you've done a really good job managing spending during the pandemic. Thinking ahead beyond this year, how should folks think about potential OpEx growth in a more normalized, hopefully a post-COVID environment?
Hi, Greg. This is Colleen. Thanks for the question. I would expect that we're going to continue to leverage our operating cost structure as we had. You will see some, return of expenses as we've started to see this year as things open up, but we will be managing those to fairly stable levels and continuing to leverage our operating structure.
Great. Thank you.
You're welcome.
Thank you. Our next question comes from Oren Livnat with H.C. Wainwright. Please proceed with your question.
Hi, thanks. I have a couple. I totally understand that patient starts and switches are obviously less likely in non-exclusive books when patient visits are down. But you also said a couple times in your script that you do plan to focus on driving adoption in the second half in those very books. So how do you do that? What can you do differently in second half than that you haven't done in first half? And I have a separate question. Thanks.
Yeah, thanks for the question, Oren. So how we do that is the commercial focus that we have. So we've launched new materials. We have some new marketing content we're putting into the marketplace, some new messaging to create the need for a differentiated abuse deterrent technology. So when we're able to get in front of the physician live, it's through that differential messaging and focus that we actually get to growing the non-exclusive books of business.
Okay. And I guess I'm just wondering if there's a tipping point where physicians have enough patients and enough experience, with patients who have had to switch because of exclusive plans and successfully switched, either new starts or switching from, ER to ER. When do docs just get more comfortable and say, okay, new patient face-to-face visits or not, or exclusive or not, I've had 100 patients that I've successfully moved over because I had to, because of their exclusive coverage, and now I'm, comfortable with Xtampza ER. So why wouldn't they, be pushing more non-exclusive lives over, COVID or not?
Yeah. So Warren, this is Joe. That's a great question, and I really appreciate you asking it. Look, at the end of the day, our strategy, as we've been very clear from a payer and physician experience perspective, is not to get every life in an exclusive position, but to get enough scale so that the experience a physician and importantly their staff has is that they can get access to all of their get Xtampza ER access for all of their patients.
All right,
now, what you just touched upon and what we're not able to get a clean read on because of the COVID dynamics is with the scale of access we have, which is roughly 45% of all lives in an exclusive position, is it in fact spilling over? And the issue is with pain specialists, when they switch an otherwise stable patient, chronic pain patient, they want to have that conversation more often than not with the patient in person. Hence why it is relative to what our expectations have been for this year, we're not seeing the growth in contracted non-exclusive or non-contracted where the payer isn't driving or encouraging the physician to switch. So that's something we were hoping to get a clean read on in the second half of the year. But as Scott alluded to your first question, that's what we're focused on to the back half of the year in terms of our commercial effort.
So I guess if I could just follow up on that. If COVID ended tomorrow and we had a deluge of patient visits, do you
I'm not
think
really big on crypto.
You would have more growth in second half? I call it organic growth in the non-exclusive or dynamic part of the market than we saw last year, because that was a big narrative coming into this year. We were hoping to see a little bit steeper curve once you got past the initial bolus of exclusive lives. And I'm wondering, do you think we would have seen that without COVID, or do you think it would still be, a slog to penetrate that business?
Yeah. So another great question. It's never easy, but our belief is if we were in a world of the return to new normal or a non-COVID environment, our expectation is that we would have and would see more progression, both in contracted non-exclusive and even non-contracted books of business. And as we've talked about, we believe we are focused on mix. We also, and I'll emphasize again, we are absolutely committed to managing Xtampza at a gross to net of less than 65%. And we would do that through the optimization of contracts as we have opportunities, and no later than in 2023. We have a lot of opportunity in 2022 to optimize. And the final point I would make, which I do not believe will be the case, if we were to find that we weren't able to have impact in those books of business through our commercial effort, we would address our cost structure to ensure we were having an impact of a gross to net of less than 65%. But we believe that we can and we will, but ultimately we need to see it, but we need to have a clean view to be able to make that call.
All right, appreciate it.
You got it.
Thank you. As a reminder to our audience, if you would like to ask a question, please press star 1 on your telephone keypad. Our next question comes from Brandon Folkes with Cantor Fitzgerald. Please proceed with your question.
I don't know doors either.
Brandon, you may proceed with your question.
Come on, Brandon.
All right, I believe we lost Brandon on the line there, and it seems there are no further questions at this time. I'd like to turn the floor back over to management for any closing remarks.
Great. Thank you all for your attention. I'm encouraged by our overall performance the first half of 2021. The fundamentals and positioning of our differentiated pain portfolio are strong, as is the financial position of the company. Our priorities for the remainder of the year are clear, and we are focused on growth and value creation. I look forward to updating you on our progress. Have a great evening.
Ladies and gentlemen, this concludes today's webcast. You may now disconnect your lines at this time. Thank you for your participation, and have a great day.
All right, that was like perfect timing. Finished all the available financial data right as the call ended. Couldn't have planned it better. So let's get into this a little bit. See if Google Sheets wants to like function today at all. Data importing functions have been acting a little quirky for the last few days. So, as he was kind of saying there at the very end, kind of his little closing statement, talking about how great their financial position is and cash management and capital management and all that, that is definitely true as well. When I was kind of talking at the start of the stream about their products and the revenues and stuff like that, I didn't really get into a lot of the other factors, but that's some of the reasons why that's kind of pulled my attention to this company in the first place, is that their return on invested capital is relatively high, partially because of the high amounts of cash on their balance sheet. Because by having a large amount of cash on your balance sheet, you're bringing your net cash position down, which brings your total invested capital down, which brings your return on invested capital up. And they're also finally profitable in the most recent year. After several years of not being profitable, you can kind of see that on their sheet here. It's like their reported profit, negative, positive. And then that was in fiscal year 2020. In the 2 quarters since then, it has been significantly even more profitable, way more profitable, 4 times its profit. So it's been a very sharp increase in the most recent year. So starting to look like it's on that kind of tail end of things. And then, I mean, I have my own adjusted profit figure, which isn't terribly far off from theirs, to be honest. By the end of it, So it's profitable. And then I haven't scrolled all the way over because if you come over here you might see this, but don't pay too much attention to this because we still have a lot of things to adjust before we actually get to a real answer. Because like these margins are not what we're gonna probably go with at all. Like I already said at the start of the stream, this is the revenues I'm gonna go with, and I kind of put in this probability distribution, which is kind of weighted towards the midsection with some tail end probabilities, but it's not in any sort of final state. We might adjust it to actually be closer to that. Honestly, we may adjust this a little bit as we go, but we got to figure out margins and capital ratios first, and debt ratios. We come down here and see what their actual debt is like. They're actually only about 9% debt to equity. So yeah, way too much debt also listed on the kind of generic setup. But anyway, back to their little presentation. As they said, they got like $200 million in cash on hand. That's a significant improvement as well. You can kind of see they've had some good cash on hand regardless, but it's steadily been growing with only minor little dips. And they also started doing share buybacks in the most recent quarter, when prior to that they were also issuing shares, which we saw a decent amount of throughout here. Every single year they've issued at least a little bit. It's been a few years since they had major share issuance, but they're still at least issuing small amounts just on the fact of optionality without ever paying it down through buyback. So they've issued share buybacks in the most recent, if you include the most recent 2 quarters and get to an actual trailing 12 months, then it does actually drop the share count ever so slightly, which is good because they do have a shitload of extra dilutive securities. This is options and restricted stock and convertibilities. So it is actually closer to 43 million shares outstanding, even though they're kind of listing closer to 35 million by my way of counting it. So that's just another fact that has to be taken into account. After adjusting for debt to equity and we'll actually check their interest rate. Yeah, see, their interest rate doesn't make sense because of the way that they're reporting their debt payments. So it on a rolling 3-year period believes that it's actually been 65% interest rate, but that's just because of the way that they weren't listing their debt costs through GAAP. So companies do that all the time. So if we shift it to the listed figure, which we calculate based off of their listed debt in the 10K, which we got to 9.41% with a weighted average maturity of 3 years, $272 million. It makes it still basically worth $272 million. And see, you adjusted that, and then also let's check the tax rate. Yeah, so their listed tax rate is negative right now, partially because they have the last 3 years on average negative of a net income as well, which we will shift to either a 2-year average or a 1-year average. It's like, do we actually want to count that year and consider that a base year, or is it safer to assume that the no profit is a better base year? That's the real question. We'll think about that a little bit, but either way, the tax rate we are putting in here, this is just looking at their historic tax rate, but the tax rate itself is applying towards the future for perpetuity. So if we want to think about this tax rate, we need to adjust it so that it actually makes sense for the long run. They are going to have some carry forwards, but I was doing the math on the carry forwards, but they've actually used up a lot of it relatively quickly. So I'm going to shift it into a positive number and just kind of multiply it up so that it becomes at least a reasonable figure. We'll keep it relatively low, like 10% still a pretty low tax rate, but it needs to be something at least positive and rational for a long-term average, because that's the tax rate that goes into our debt to equity and cost of equity. So now that we've adjusted that, it actually brings the debt to equity to 30%, when before it was reporting a much more inaccurate number. 30% is much the accurate figure, which gets us to a cost of equity of 6.59%, which is not terribly high. Weighted average cost of capital 8.28%. Turns out that their equity has been cheaper for them than their debt, which might make sense for why they're diluting so much. To be honest, that actually would make that the smarter business move. But we still either way need to adjust our expectations for the debt to equity ratio for the future. If they're at 30% now, let's assume maybe on the best case scenario it's like half as much. Worst case scenario, it can be perhaps twice as much. That's sort of just like a general baseline of thinking I use for a lot of these things. Variability shifting to 30%, that gets us to weighted average expectation of 40% is higher. So we can maybe shift this down to 50, and it's 34. I'm satisfied with that figure. They'll probably get rid of their convertibilities over time, but they'll probably take on some bonds at some point or another once capital markets become a little bit more comfortable with them. So yeah, I'm okay with those debt figures. Now, if we look up at sales to capital, this is where things get a little bit tricky because they've had such a non-stable capital base for the years since they IPO'd. You can see that it doesn't really report a meaningful sales to capital number for several years, which gets our 3-year average to also not be very meaningful. So we'll just go ahead and use the 1-year average, which says 1, which is actually pretty decent for the expectations of their industry as a whole. But whether or not they can maintain that is the real question. Or if they make their capital base smaller, which they've been successfully doing, then maybe they can maintain that as their sales grow. So like I said, normally I would expect this to be a little bit lower for their industry. So it's interesting, in line with my kind of general default expectations that I already had here, which is again about 50%. The worst case scenario with maybe 50% more. Best case scenario with the analyst number kind of leaving it in the middle. Gets us an expected ratio of 0.94, which is a slight decline, so I'm pretty comfortable with that. So that's pretty good for them, actually. That leads us to returns on invested capital, which for the last 3 years are incredibly high. Again, like I said, a relatively small capital base as a result of the capital markets not being super available to them, but them still managing to get their returns up relatively quickly. So that's actually pretty decent. 67% is really high. The fact that this came down to 18% is much more in line with what we could expect for them in the long run of things. So we can also shift this to the 1 year, which after you take out their cost of capital, gets us excess returns of 9.6%, which is pretty impressive. So then we come to margins. That is the last real question. What sort of net income margin are we going to look at? We've already looked at their capital expenses. We've looked at their debt. We've looked at their revenues. Might shift around the model distribution, but the model distribution applies to all of these factors. So that's why we wanted to wait till we had a margin answer as well before we shifted it any more, I guess. And the fact that we decided to go with the 1 year number for return on invested capital and for the sales to capital ratio makes me, by the way, much more comfortable with leaving the 1 year figure as my average for the net income margin, because that just seems to be the way to go. In fact, you could argue that maybe I could just use the 1 year for the debt as well, and that maybe issuance costs are pushing it above on that. Doesn't really make a huge difference. It does help them a little bit, so maybe I'll give that to them if I still need to be more what's it called? If I need to be more gracious to their valuation, if I feel like being more charitable. But anyway, so margins. This is where we have to decide how charitable to be to them. Worst case scenario, it might be smart to leave it at like 0%, which my calculation often doesn't like, depending on a lot of other factors. But we are going to raise the top end of things. The way to bypass this is to not use 0. The reason why it doesn't like 0 specifically is because that means at some point in the calculation it has to divide by 0, and it doesn't like that. So that's sort of the issue with that. But I can fix that issue just by simply going past it a little bit. -1 will get me the same effect at the end of the day. it just pushes this number a little bit lower. So we could put this at -1. Now for their industrial average, as we already saw, they had a higher sales to capital ratio than their industrial average. Their industrial average for net margins is close to 25%. So if we assume that because of the fact they had higher sales to capital ratio than the industrial average, that they'll probably have a little bit of a lower net margin to counteract it, because those things are usually balanced. So we can assume that maybe if they become relatively successful in steady state with their product, that we could assume that they might have about a 20% net income margin. Which means for a best case scenario, maybe I'll put it actually up to 25%, maybe even to 30%. Because again, we're dealing with tail end probabilities here with only 10% of the probability. So 40% is going to be weighed into this outcome right here. So 40% likelihood of 12% margins. That's pretty easy to see, I think, personally. 30%, it would shift that number to 14.5%. So do you see a easy to see 40% likelihood of 14.5%? But then at that point, like I said, we could also shift these numbers around. We could shift this to 35, and so it's a little bit more balanced. So we really have to say is like, okay, it's a balance between these two revenue figures. Maybe they've achieved these revenues, but maybe they do actually have a pull off for the next few years. But the revenues pull back. But what they do manage to do is stabilize their net income margin at 6.75%, which overall would be much better than they were in 2019 still. So that would be one outcome versus also another 35% chance of having the 7.5% sales CAGR, but achieving 14.5% net income margin, which would be a huge increase from the current net income margin. But it also would still be significantly lower than their industrial average. So that's sort of how we look at this. The distribution of probabilities applies to both the net income outcomes here as well as the sales outcomes. You have to sort of think about them together, which is where I get to like my final presentation page. It has each of these listed. So this is sort of what we're looking at. Is 7.5% sales growth with a 14.5% net margin versus possibly a slight decline in sales growth but still achieving a positive net margin versus a massive decline and becoming unprofitable permanently, versus possibly having a smaller chance outcomes of these really high probability outcomes with a much higher net income margins. And we can still adjust the analysts numbers. These still need to be kind of figured out. Otherwise, I think I'm okay with this this range, -1% to 30%. I think I'm okay with that. The expected value comes out to 11.5%, which means after you distribute all the probabilities. So 11.5% is essentially what the expected value of net incomes are on an expected value of 4.5% sales growth. So I think that's pretty reasonable and altogether not overly gracious to them. I think it's reasonably conservative in some ways. It's like the net income margins, I think, is giving them a pretty strong potential outcomes overall, considering where they currently are. But the probabilities of the revenues, I think, is a much better balance, especially since we're giving a 35% chance of decline. I would imagine most people wouldn't even be weighing that in. Actually, technically 40% total percent chance of decline. But the chances of growth are just so significantly higher. Let's see. So there is still default risk to deal with. I'm trying to decide, other than the analyst numbers, if there's anything else I wanted to look at. We'll just get straight to the analyst numbers. If we look at Yahoo, they've got 6 analysts apparently projecting for revenue, which they're saying 9.8% revenue in the next year, with 10.4% in the year after that. If we just multiply that out. And then just sort of assume vaguely revenue steady state after that. Which, I mean, analysts generally don't assume that, but that's sort of me being conservative. And then figure out what the COGR is. That comes out to a little over 5%, which is probably, like I said, a little bit low. It's probably being overly conservative. Again, I already put a 5% in there. We'll pop it up to 6% just to, like I said, it's probably being conservative. And 6, 7, 8%. It's hard to say what the analysts are going to project for future years for that. All we have are really just the next 2 years as far as analyst numbers go. But the analysts are for the EPS expecting it to remain relatively flat, slightly moving up. The EPS number is usually a little bit behind on getting updated relative to when they update the revenue numbers, so that's worth noting. And the 9.8% also applies to this year, of which 2 quarters have already passed. And of which we can see that the sales actually did happen. So that's one thing that we can confirm that the analysts were correct mostly for this year so far. There is also Zacks to look at. Which oftentimes is a little bit behind, but sometimes it includes numbers other people haven't had. Like, don't even know what's going on there. But this is roughly the same. Probably a calculation error. They don't even have a next 5 years number. Yeah, so they're expecting EPS to remain relatively flat. It's a little bit tricky to look at because of the averages of numbers, but my current EPS for them as reported was 62 cents. But that was the 2012 number. That doesn't include the most recent 2 quarters. In the most recent 2 quarters, it's significantly higher than that. Like I said, they had profit that's like 4 times that. So it is much higher than that. Whether or not that's the EPS that they expect to remain flat, or it's the 2012 number they expect to remain flat, is hard for me to say. And then also my corrected profit number is slightly different. It actually comes down to 61 cents, and that would be relative to 26 million income. So I'm distributing expected income of 57 million. So if they're saying from the trailing 12 months of the most recent 2 quarters, that EPS, if that's supposed to remain flat, then they're saying the EPS would be double the implied EPS of this net income in the 5-year forward period. Now that doesn't necessarily mean that the income's doubled. It means that the implied EPS is, because I'm looking at income, not EPS. So it's possible that they actually have an expected income roughly the same as I do, but they're also thinking that the share count is going to get cut in half or something. Probably not. It's probably a mixture of those things. Like the share count is going to get cut significantly, but then maybe their expected income is also 50% higher than mine, which I'm okay with. I'm fine with being conservative on that end. It's worth noting that when you do the distributed expected income number, it includes the negative outcomes. So it's also including these really negative outcomes. The expected revenue number is usually a little bit more meaningful than the expected income number, because the expected income number is dependent on the expectations of the revenue number. This follows from the above line. So it's usually not so meaningful. Like these individual income lines all mean something very useful, but the expected number, it's usually too wildly variant for it to be super meaningful. So anyway, long way of saying that we can raise the net income for expectation for the analysts higher than 10%. But what we want to do is we want to get this number right here to maybe 50% higher than this. So maybe 75, 80 or something like that. I think that's sort of the range that I want it to be. Okay, so that's 83. So we go a little bit lower, 75. Okay, so 18%. That's what I'm going to say is sort of the implied analyst's net income margin, adjusted net income margin. So it's like converting net income margin to my net income margin still. But if they were using it and if they were to make a projection, this is what I would say is sort of the implied level of that. So that gets us to that. Is there anything else that needs adjusting? Again, we could shift the probabilities. I tend to be very conservative by nature. Part of me wants to just shift it a little bit further back like this. But that's the thing about these valuations for anybody that does watch these, is that if you like my methodology, but you disagree with the assumptions that I'm putting into these boxes, but overall you think the methodology still makes sense, well then you can essentially readjust this yourself. You could just take the values and then reweigh them by whatever probabilities you want to assign to the assumptions I put in. So you can, if you're thinking that it's like, oh no, it should be more weighted towards this end or more weighted towards that end, you can do the math yourself and you can come up with your own weighted present value, because that's essentially what this is. This weighs at these probabilities, these outcomes, and it comes up with this number. So it's worth noting that it's like anybody that disagrees on some of the minor assumptions that I put in here, you can actually adjust it yourself even without the spreadsheet, just with a little bit of math. But so as I say that, like I said, because I just shifted this to maybe more conservative, but somebody else watching might look at this and think, no, I don't want to be more conservative, I want to be less conservative, and actually say that there's a higher chance of this happening. That's basically what we're doing here. So we're thinking about worst case scenarios, thinking about best case scenarios, and trying to determine what is the major differences between the two, what is the likelihoods between them, and how does that adjust everything. I think I'm pretty good on everything else. I'm satisfied with that. Google has to start being weird again. Last possible moment. Come on, Google, cooperate. Anyway, I can still talk about what I was going to say. But just to say that the expected returns on invested capital do drop from close to 18% in the most recent year to closer to 14% based off of this distribution of outcomes as well, which is good. I generally like to see that number dropping over time. It makes more sense for it to drop over time, but it still maintains a positive level over its cost, which is generally good of the investment. Come on. For exactly what the figures were, but copy this. Why is it not? Oh yeah, okay, now you work. As soon as I'm about to put the information over, it's like, wait, don't do it. Okay, sorry about that. Sometimes you have to deal with issues on that. Oh, to answer your question, I'm using the discounted cash flow formula. I'm not sure how knowledgeable you are on that, but it's not a future PE. It's the perpetual growth model is what it's often referred to as, or the dividend discount model, or Gordon growth model. It has multiple names. But here, let me. The basic idea is it's a little more complicated because I'm not using exactly net income. I'm using cash flow after I readjust for reinvestment. But either way, okay. So you have the net incomes coming out. This, we'll just use this bottom line right here. I have for year one 34 million, and then it goes to 43 million, 52 million, 63 million, 75 million, and those are the usual years for the discounting. And most people think about the discounting underneath those years, and then what they do is then they take this number here and then they apply a multiple to it, and then they use that to get their share price, and think of that as the terminal value being a value of the future PE multiple, which is what I believe you're referring to. But I don't do that. I use instead what you use is the next year's cash flow that you're expecting from that, which usually you use like a 10-year treasury as the growth rate. Then you divide it out by the discount rate itself to essentially assume that you're going to earn that same amount of cash flow in the future, but slightly higher every single year, and then you discount it every single year until it turns to nothing. If you want to. Yeah. Just type this into search engine, Perpetual Growth Model, Corp Finance. This website right here, corporatefinanceinstitute.com. They're really, really useful. Yeah, so this is sort of like the concept that I'm talking about right here. It's like a lot of people use an exit multiple so a future PE multiple based off of the net income 5 years from now, and then a PE multiple times that, and then they assume that to be the share price that they're going by. That's what you're talking about. Instead, what I'm talking about is perpetual growth, where instead you have the cash flow of a specific year number 5 years out or whatever, and then you multiply that times 1 plus the growth rate that you're expecting to have every single year, and then you divide that by the discount rate minus the growth model. These are like the two common forms of terminal value. Yeah, so like this is the one that you're kind of referring to. It is extremely common. Like on YouTube, you'll see a lot of people talking about this. Not very many people do what I'm doing, but what I'm doing is as it says right here, the more academic approach. In my opinion, they're not that different. That's the thing. It's like if you actually understand where multiples come from, it's the same thing. Most people don't really realize this, and I'll show you. But if you use like the formula that's down here, let's just assume the cash flow is 1. So just 1, because that's like it's 100%. So it's just a ratio of 1, so that we can do this thought experiment. And then you multiply this by 1 plus a growth rate. Now let's just assume that 2% is our growth rate, or perpetual growth rate. So 1 plus the growth rate, you're going to get 1.02. Now we divide this by our weighted average cost capital minus the growth rate. Let's assume our weighted average cost capital is 7%. That's just a pretty typical discount rate one might use. So 7% minus the growth rate, the same growth rate, which is 0.05%. So 1.02 divided by 0.05 gets you 20.4. What does that look like? That looks like a PE ratio. Interesting. It's interesting how that works out that way. This formula, the term perpetual growth formula, will spit out a number that looks remarkably like a PE ratio. And if you increase this discount rate to a higher number, then the PE ratio gets smaller. If you lower the discount rate, then the PE ratio gets higher, which is why when interest rates go low, that PE ratios for stocks go up, and why when interest rates go up, the PE ratios for stocks go down. So it's like these things are actually directly tied to each other. Most people just don't understand this. So it's like PE ratios in a large way are like the layman's approach to the same thing. It's the simplified explanation of this formula. Most people don't like math. They don't really want to think about it. Formulas are tricky. Think about it. A lot of people just don't like math. Like you can be really good at investing and not be good at math. It's true. It's very, very true. If you're very creative about brand names and market share and thinking like that, I mean, you can be a really great investor and not be good at math. But if you understand math, then you can understand these things. That's where PE ratios actually come from. Is that formula? It's basically just the simplified way of dealing with it. But yeah, so I use the formulas though appropriately. But if we did some math, we could essentially sort of figure out what that future PE would be. I do use multiples a little bit. I do like to look at them, kind of like compare. That's what I usually doing down here, is that I'm kind of I come up with a multiples based off of the industry they're in. I sort of like spit out what type of multiple I would expect them to have based off of their balance sheet ratios, and then I come up with a price that I would expect them to have based off that. But this is sort of like icing on the cake extra for me. It's like maybe for timing and stuff. So it's like if the value looks good and the pricing expectation looks good, then it's like maybe that means the market will side with me quicker. Not necessarily. It's like I said, it's just like icing on the cake. But yeah, so long way of saying is like you can use multiples. Just because I'm not using multiples doesn't mean it's bad or anything. But it does help to understand where they come from. So anyway, like I was saying, we are basically done. All I need to do is adjust default rates. Oh, hold one moment. Sorry about that. I had to let my cat in. Alright, so now we adjust for the chance of default, because in any of these years, it's possible that they won't be able to pay their bills, regardless of whatever net income they might get. The thing about that is because net income is different from cash flow. So just because you have a gap in net income doesn't mean you actually have cash available to pay your bills, because you might have had just some sort of paper profit or something as a company. So depending on how much net income you have, there's a higher or lower chance of not being able to pay your bills regardless. And we use historical data to figure these things out and compare it to credit ratings. And we essentially assign companies an artificial credit rating based off of what we would expect them to have. What credit rating would we expect them to have based off of the credit ratings of other companies? That's basically how I do this default risk thing. And then based off the default risk, we essentially say we chip off their value approximately that much per year based off of that chance of it going bankrupt. And we replace it with whatever amount of tangible book value they have, if they have any, which they don't for this company. That is what it is. Most companies don't, honestly. So anyway, do that real quick. It does look like they're going to have relatively high chances of default, which is not super great. Do some readjusting because the numbers shift around depending on the default risk itself. It's a little complicated. Five, 7. All right. Yeah, so it's a relatively high chance of default for them. For each of these outcomes, this is the different chance of default per year. This is a per year chance of default. So on an expected basis, we come to 3.79% per year. So that for 5 years. So that's a pretty significant amount. I usually like to see it closer to 1% or lower, personally. But so anyway, this is it. I think that's everything that I'm gonna do to this valuation. Again, ticker COLL, Collegium Pharmaceuticals. Today, the U.S. Treasury is 1.59%, and I come to an equity risk premium for them of 4.86%. Based off that, I come to a discount rate after adjusting for their industry of 6.46%. They do not currently pay any dividend. 5 years ago, they had sales of $0. They IPO'd that long ago, and they didn't have any drugs under the FDA approval at that point in time. In the most recent year, it was $310 million. So not really a meaningful sales growth number between zero. So that is what it is. Sales to capital ratio in the most recent year is approximately 1, which is pretty decent. Returns on invested capital of almost 18%, which is also pretty decent. And debt to equity ratio of 26%, which is not bad either. I didn't actually determine what their default risk was in the most recent year, but this is what I mean. Difference. It's just kind of for writing it down. But it was 2.77%. So 2.77% default risk. They've been kind of riding on a decent amount of default risk every single year for a while now. That is what it is. That's just part of the pharmaceutical business. Profit margins in the most recent year of 8.52% in their first year of profit. And that was a profit of $26 million. They're currently selling for $21.18. We're using a probability distribution that is heavily leaning towards the negative side of things, with tail end probabilities of extremely positive outcomes with some decently negative outcomes as well. That's just what it is. Based off that, we have revenue expectations of anywhere from $183 million to possibly $946 million. On an expected basis, we would assume about $400 million in the 5-year forward period. That gets them a sales growth expectation of about 4.21% per year, and we are assuming sales of capital 5 years from now of about 0.91. Based off that, we expect them to have returns on invested capital of about 14%, which is higher than their cost of capital, so that's pretty decent. And debt to equity ratio, they might take on a little bit of extra debt to achieve this, which is fine. We would expect that, and that would get them to maybe about 35%, also reasonable. Based off that, we would expect a R&D adjusted profit margin of 12.31% on an expected basis, which gets us an adjusted distributed profit level of about $60 million. Again, not super meaningful because of the wide differences in the outcomes there. So it's not super meaningful, this specific number. It's really just the range that's meaningful. But based off of the discount rate that we are getting, that gets us to a present value of $21.38, which is only 1% higher than its current value. And based off of the discount rate, we would get 5-year forward value targets of anywhere from basically worthless to possibly $140 per share on the high end of things. Based off of probability distribution, we get to an expected value of about $29.23. And compared to the price it's selling at today, that gets us expectations of 6.65% returns per year for the next 5 years, which is not very impressive. Ever so slightly higher than the expected return of the market, but not really. And then, like I said, short-term pricing multiple regression gets us a suggested price of $24, which is 13% higher than the current price. So the market multiple regression kind of implies that maybe there's some short-term upward movement to the stock, but I do think it's in general fair value and doesn't really have much of a margin of safety to it. Based off of qualitative factors, I get to kind of a buy value score, which is my own personal buying comparison metric of 0.9, which isn't bad, but also not very exciting either. So it just is what it is. So either way, yeah, that's Collegium Pharmaceuticals. It was a pretty interesting one to look at, considering its products and the kind of all the controversies surrounding it. I thought maybe there would be interesting value opportunity here, mixed with some interesting growth. Definitely pay attention to it. It might might crash or something. If you look at its chart over like its existence, it's definitely had a whole lot of wide ups and downs, and it's been kind of trading in the same range basically the entire time it's been on exchanges. So it's easy to argue that an opportunity for this would show up in 6 to 12 months. You just gotta wait for it to have some bad news related to opiates probably, and then it probably takes like a 50% dive or something. I don't know, but that's definitely what the chart seems to imply, is that opportunities in the stock could easily arrive sooner than you think. So I'm not buying it, but that doesn't mean I couldn't buy it in the future. So that's going to do it for us today. I'm not sure what I want to look at next on Friday. I kind of actually skipped one or two of the items that was on the list that I was looking at before, of the companies I was planning to look at. I was planning to be looking at a company, Kazaki Telecom, but it turns out I don't actually have a way to purchase that stock, so I decided to bypass that one. But I can't remember which one's next on the list, but either way, we'll be back again on Friday. So please like, subscribe to the channel and all that jazz, and thank you for watching, joining us. Thank you, DT, for your comments and participation. It's always enjoyed, and I'm always willing to try to explain something if I can.